19th century, many farmers focused on only one crop, cotton, to cover their family's income needs. George Washington Carver revolutionized the agricultural industry by introducing crop rotation. He encouraged farmers to rotate cotton with nitrogen-rich foods like sweet potatoes and peanuts in order to add nutrients back to the soil and ultimately yield more crops. Carver's wisdom transcends farming and applies to the investment landscape today. Since the 2008 financial crisis, interest rates have remained historically low. Many income-seeking investors were forced away from fixed income and into alternative assets. The most popular place to find income was stocks. In a world of ultra-low interest rates, there was no alternative to generating both current income and future income growth with stocks. However, times have changed. The yield on the 10-year U.S. Treasury now is over 4.5%. We haven't seen the 10-year this high in over 15 years. And after adjusting for expected inflation, these bonds now offer a 2.18% real return over the next decade. This exceeds both the long-term average of 0.86% and the pre-2008 average of 2.06%. Other fixed income assets offer even more attractive yields. The Bank of America Corporate Bond Index now yields 6%. Even short-term investments like the 3-month U.S. Treasury bill yield over 5.4%. This major shift in the interest rate landscape affects your portfolio in three main ways. The first is that investors can now use fixed income for generating income. In 2012, DCM initiated Operation Tilt, which was a move away from traditional fixed income assets and more towards alternatives like equities, preferred stocks, and bond proxies. In our October 25, 2012 quarterly letter titled Dividends Are Forever, we wrote, "A couple of months ago, our investment policy committee initiated Operation Tilt. Our goals in this highly unusual bond market are to preserve capital and continue to provide income for those clients who need it." At the time, more than 140 stocks in the S&P 500 yielded more than the 30-year U.S. Treasury bond. Today, that number has been cut in half. Fixed income can now provide generous current income, which takes the pressure off of stocks to produce both income and growth. Secondly, in this environment, it's more important to focus on dividend growth, not just dividend yield. A stock with a dividend yield of 4% and very little dividend growth may have been attractive whenever interest rates were nearly 0%, but today it's not nearly as attractive with the 3-month U.S. Treasury bill generating 5.4%. Stocks with lower initial yields but faster growing dividends will be increasingly prized, particularly in this challenging economic environment. And finally, quality matters again. During the zero interest rate years, companies, even those with no profits, could still access credit from the debt markets and equity markets. However, with a higher cost of capital, these companies no longer have access to cheap money. We believe this is a favorable development for the kinds of companies that we invest in. Not only are dividend-paying companies able to generate enough cash flows to cover their current needs and invest in future growth projects, but they have even more left over that they can use to pay as dividends. For these companies, debt is a tool to be used, not something they have to use in order to survive. In this rising rate environment, we would expect these stronger companies to be able to pick up market share away from their weaker competitors. The days of single crop investing in equities for income are over. For income-seeking investors, fixed income is now offering yields that we haven't seen in over a decade. Investors can now build a more diversified portfolio where fixed income can provide for current income needs and rising dividend equities can provide for longer-term income needs.
I hope you found that valuable. If you have any questions, I'd love to hear from you. Thanks for letting us serve you.